Have you ever wondered why some people always seem to be ahead, earning money sustainably and living a financially free life, while we continue to struggle with bad decisions? The secret isn't luck or innate intelligence, but simple principles that wealthy people consistently apply. In this video, I will share with you 8 simple steps to build wealth. They're the keys to long-term success. Are you ready to change your perspective on money and achieve financial freedom? Keep watching this video and uncover the secrets behind true prosperity. Step 1. Building a solid income foundation. On the journey toward wealth and true financial freedom, there's one crucial principle that many people overlook: the power of income diversification. There are 3 main types of income that everyone should understand and begin building, step by step, because each one plays a different role in helping you grow your wealth and protect yourself from life's unexpected storms. The first type of income everyone is familiar with is active income. The money you earn by trading your time and effort. This includes working a 9 to 5 job, freelancing, or running a business. Active income pays for your living expenses, but its biggest limitation is time. You only have 24 hours a day. Even someone like Elon Musk, who famously works over 80 hours a week, understands that true wealth requires more than just hard work. It requires building income streams that don't depend on personal labor, like stocks, technology, and investments. Next is passive income, where money works for you. A classic example is rental real estate. Once you own a property and rent it out, you can receive steady monthly income without daily effort. Robert Kiyosaki, author of Rich Dad, Poor Dad, built a strong financial foundation using this model. Passive income not only reduces your work pressure, but also secures your finances even if you stop working. Finally, there's semi-passive income, a hybrid where you still put in effort, but much less over time as the system runs mostly on its own. Think of Airbnb rentals or building a YouTube channel. Initially, it requires time and work, but once the foundation is set, income can flow in consistently. Casey Neistat is a great example. He started making personal videos, and over time, his content attracted millions of views. YouTube became a major, semi-passive income stream for him, offering both financial rewards and time freedom. Relying on just one source of income is a silent risk. Imagine losing your job or facing a crisis in your business. If that's your only stream, everything could collapse in an instant. Warren Buffett, one of the greatest investors of all time, has always advised, never depend on a single income. He spreads his wealth across many investments to both protect and grow it over time. The key to real financial freedom is building multiple income streams: active, passive, and semi-passive. Even if you start small, the most important thing is that you start. Don't sit around waiting for opportunities. Go out and create them. And always remember, smart income doesn't come from working yourself into the ground forever. It comes from building systems that generate income, even while you sleep. Take action today, because your financial future depends on it. Step 2. Investing to build wealth. When I began my journey to building wealth, I realized something crucial. Stable income alone isn't enough for long-term wealth. While your current job might help cover your living expenses, if you only rely on a monthly paycheck, you'll never break through your financial limits. To truly grow your wealth, I shifted my focus from just earning money to making smart investments. One of the first steps I took was to move into passive investment. That is, I began earning not just from my job, but from investments that would provide long-term returns. This not only allowed me to grow my wealth, but also created a steady stream of passive income, a critical element in building a strong financial foundation. But why did I choose to invest passively instead of just earning through my job? The answer is simple. Investing allows me to grow my wealth without having to grind every single day. These financial tools help me turn my capital into a stable source of passive income. While passive investing is enticing, I learned a critical lesson. Not all investment vehicles offer high returns. One common mistake I've seen is people investing in low-interest tools like fixed deposits or public-provident funds. These are safe options, but they won't grow your wealth quickly. You've probably heard the advice that putting money in the bank is a safe way to protect your personal finances. But in reality, The interest rates on these tools are too low, and they won't help you overcome inflation, the silent enemy that erodes the value of your money over time. Imagine putting a large sum of money in a low-interest savings account for years. In the end, you'll have a small sum that can't meet your future financial needs. Take Warren Buffett, one of the greatest investors of all time. He consistently advises against low-interest investments. He once said, "If you don't find a way to make money while you sleep, you'll work until you die." Clearly, investing in low-return tools like fixed deposits won't help you achieve long-term financial goals. The main problem with slow investment tools like bank savings or public provident funds is that they can't keep pace with inflation. Inflation is the phenomenon where the value of money decreases over time. And if you don't invest in vehicles that can offer returns higher than inflation, you'll see your wealth slowly eroded. For example, in recent years, inflation in many countries, especially the US, has been quite high. Interest rates on traditional savings accounts are only around 1 to 2% annually, while inflation has been 3 to 4%. This means that even if you save your money in the bank, you are losing its real value. Therefore, investing in low-return tools is merely a way to preserve money. It won't build wealth. Think about successful entrepreneurs like Jeff Bezos, the founder of Amazon. Bezos never placed his money in safe financial instruments like savings accounts. Instead, he chose to invest in projects and businesses with high growth potential. Thanks to those bold investment decisions, he built a trillion-dollar empire. To achieve strong, sustainable wealth growth, it's crucial to choose investment tools with the potential for exceptional returns. Investing in stocks of large companies, mutual funds, or real estate are smart options if you want your wealth to grow rapidly. Specifically, companies in technology like Apple, Google, or Tesla have proven that investing in high-potential companies can yield massive profits. So, if you want to grow your wealth, don't settle for safe, low-interest investments. Look beyond, find high-potential opportunities, and start building a sustainable financial future. Step 3. Diversifying assets. After I started investing and saw steady growth from my initial investments, I quickly realized an important lesson. You can't just focus on one asset class. To build sustainable wealth and increase value, you must learn how to diversify your investments. This is one of the success keys I discovered on my financial journey. Why should you diversify your assets? The answer is simple but crucial. Each asset type operates on a different cycle. This means they will respond differently under various market conditions. If you focus on just one asset, you may miss out on profit opportunities from other assets or even face significant risk if that particular asset is heavily impacted by a specific factor. The first reason I started thinking about asset diversification was because I didn't want all my money to be trapped in a single type of asset. When you invest in just one asset, like stocks, you can easily be affected by market volatility. But if you hold various types of assets in your portfolio, you reduce risk and increase your chances for profit. You've probably heard Warren Buffett's famous quote, "Never put all your eggs in one basket." That's the fundamental principle of asset diversification. If you put all your capital into one company or a single asset type, you're taking a massive risk. Think about diversifying your investments into different asset classes such as stocks, real estate, and even cryptocurrencies. This not only protects you from financial shocks, but also helps your wealth grow stronger in the long term. To better understand the importance of diversification, let me share a few examples of markets that follow different cycles. You've likely heard about the boom and bust cycles of the stock market, the fluctuations in real estate prices, or even the wild swings in Bitcoin over the years. These markets follow completely different cycles. The stock market tends to be highly volatile, but it can also provide quick profit opportunities if you pick the right stocks. For instance, in 2020, when the COVID-19 pandemic hit, the stock market experienced a sharp downturn. However, savvy investors like Chamath Palihapitiya, dubbed the king of SPACs, seized this opportunity to invest in tech and healthcare companies, reaping enormous profits when the market rebounded. As for real estate, this is an asset class that operates on a longer cycle and is less affected by short-term market fluctuations. While property values can drop in the short term, if you hold on for the long haul, the value of your assets will appreciate over time. Well-known investors like Robert Kiyosaki, author of Rich Dad Poor Dad, have emphasized that real estate is a solid asset that can generate significant passive income if you invest wisely. Finally, cryptocurrencies, especially Bitcoin, have a unique cycle. Even though Bitcoin has gone through numerous bubbles and crashes, if you're patient and hold on to it for the long term, its value can soar. People like Elon Musk have made bold investment moves into Bitcoin and other cryptocurrencies, which has led to immense profits as this market exploded. One strategy one used to increase my profits is to look for undervalued assets. Investing in these types of assets can yield substantial returns when their true value is realized and their prices rise over time. This is akin to buying shares in a company that's struggling but has the potential to recover significantly. Legendary investors like Carl Icahn and Bill Ackman have built massive fortunes by investing in companies that were beaten down in the market. They didn't just look at the current value, they assessed the future potential. Similarly, in real estate, you can look for properties that are undervalued or forgotten but have strong growth potential. This is what I did when I invested in areas that were underdeveloped, but over a few years, their value increased dramatically. Lastly, one of the critical factors that helped me decide which assets to invest in is the ability to recognize the cycles of each market. Knowing when it's the right time to invest in a specific asset is crucial. If you can identify when a market is in a growth phase or downturn, you'll be able to make the right decisions and maximize your returns. Just like with stocks, you need to research and track the factors that affect a company's value. Similarly, when investing in real estate, you must understand the development trends in the area and predict future demand. With Bitcoin and other cryptocurrencies, you need to grasp the legal landscape, market acceptance, and price volatility. All these factors will help you pinpoint the best time to invest and optimize your profits. Always remember, asset diversification isn't just a simple strategy, it's an essential part of every investor's financial journey. Only by diversifying can you protect your wealth and achieve long-term financial freedom. Step 4. Avoid short-term trading. In my financial journey, I've learned an important lesson. Do not rush into short-term trading unless you have enough knowledge and experience. The price of impatience and ignorance can be steep, and I've learned this lesson the hard way. Short-term trading, if not approached carefully, can easily turn you into a victim of the relentless market volatility. With short-term trading, it's buying and selling assets over a brief period, sometimes only a few days or weeks, in the hope of making quick profits from small price movements. People are often lured by the appeal of fast profits, but few understand the significant risks it carries. Perhaps you've heard the saying, when you trade short-term, you're playing with fire. This is not just a cliche. The financial markets are constantly in flux, and if you don't understand how they operate, you'll likely make mistakes you can't foresee. The truth is, not everyone can succeed with short-term trading, whether they're seasoned investors or newcomers. A prime example of this is Bill Ackman, a legendary investor known for his long-term strategy and big deals. He has always emphasized that holding assets for the long term allows investors to weather market volatility and minimize risk. In contrast, with short-term trading, one wrong move can lead to immediate and sometimes irreversible losses. Beyond the risks posed by market fluctuations, one important factor that few consider is taxes. Profits from short-term trading are taxed at a very high rate, often as short-term income tax, which can go up to 37% in the US, depending on your income bracket. This is a hefty sum and can directly impact the profits you make from your trades. Billionaires like Warren Buffett and Jeff Bezos are world-renowned for one powerful trait they share: long-term vision. Warren Buffett, the legendary founder of Berkshire Hathaway, has always championed the idea that time is the friend of a wonderful company and the enemy of the mediocre. He invested in solid, time-tested companies like Coca-Cola, American Express, and Geico, then held on to those stocks for decades. The result? Massive returns built not on speculation, but on patience and conviction. Jeff Bezos followed a similar path. As a founder of Amazon, he didn't chase short-term wins. Instead, he poured billions into technology and infrastructure, building Amazon into the global powerhouse it is today. That kind of growth didn't happen overnight. It required vision, long-term thinking, and the courage to ignore short-term market noise. Bezos understood that playing the long game meant making sacrifices early to reap exponential rewards later. Short-term trading may seem exciting. It promises quick gains, fast results, and instant gratification. But behind that allure lies high risk, unpredictable volatility, and emotional decision-making. I learned this the hard way. It wasn't until I embraced the power of patience and shifted my focus toward long-term investments that my strategy and my results changed completely. Don't let the temptation of fast profits drag you into rushed, emotional decisions. Learn to be patient. Invest in assets that hold real, lasting value. Because the truth is, anything worth building takes time. Wealth, like trust or reputation, isn't something you can chase. It's something you grow. Long-term investing isn't just a strategy, it's a mindset. It's about believing in the future, understanding that ups and downs are part of the journey, and staying focused on what truly matters. When you commit to the long game, when you stay consistent even when it's hard, your future self will thank you. The rewards don't come immediately, but they do come. And when they do, they're worth every second you waited. 5. Choosing solid investment vehicles, real estate and stocks. Once I had established a stable income and was well on my way to building long-term wealth, I came to a powerful realization. One of the most crucial factors for sustainable financial growth lies in choosing solid, reliable investment vehicles. And two of the most proven and dependable options are real estate and stocks. But the key isn't just investing. It's understanding each asset class thoroughly, making informed decisions, and avoiding mistakes that could derail your financial goals. When people hear real estate, they often think of investing in housing projects or new urban developments. This is indeed a common and stable investment channel. But here's something I've learned the hard way. Not every real estate project is a golden opportunity. Areas that develop too quickly, with endless housing supply, could be risky. You don't want to put your money in places where the market is saturated, demand is weak, or long-term growth is uncertain. In these conditions, your property may struggle to gain value, and your return could remain stagnant for years. Take, for example, the success stories of investors in premium real estate markets like New York or Los Angeles. Cities where properties are scarce and demand remains consistently high. Stephen Ross, the founder of related companies, built a real estate empire by focusing on high-value, long-term projects like Hudson Yards, one of the most expensive and ambitious urban developments in New York. His approach wasn't just about buying property, it was about targeting areas with real, sustainable potential. What I've learned from studying people like him is that successful real estate investing requires more than enthusiasm. It requires research, understanding the location, the development potential of the area, and actual market demand is essential. Don't let low prices or flashy new projects tempt you into impulsive decisions. Long-term value always beats short-term excitement. Beyond real estate, I've also committed myself to the stock market, another powerful tool for wealth creation. But make no mistake, investing in stocks is no walk in the park. To succeed, you need to understand two core concepts: fundamental analysis and technical analysis. Fundamental analysis helps you evaluate the health of a company, its profits, revenue, future growth potential, and overall business model. This tells you whether the company is truly worth your investment. Technical analysis, on the other hand, focuses on price charts and patterns, helping you understand short-term market trends and behaviors. Together, these tools give you the knowledge to make smarter, more confident decisions. And when we talk about stocks, it's impossible not to mention Warren Buffett, the man often hailed as the greatest investor of all time. Buffett's success didn't come from chasing trends. He studied companies deeply before investing. His strategy: focus on businesses with strong foundations and long-term growth potential. One of his most famous investments is Coca-Cola, a company with a rock-solid business model and global brand power. He held onto those shares for decades, and they paid off massively. I chose stocks because of their potential to generate long-term, sustainable returns. Unlike real estate, which may require you to wait through full market cycles, stocks can sometimes deliver quicker value growth, especially if you invest in companies with solid growth strategies. Even better, they can also provide dividends, offering a stream of passive income while your investment continues to grow. Tech stocks like Apple and Amazon are prime examples of this potential. Under Jeff Bezos' leadership, Amazon didn't just stick to e-commerce. It expanded into cloud computing, logistics, and beyond. That constant evolution led to explosive growth in the company's stock price, rewarding investors who had the foresight and patience to hold on. Still, investing in stocks must be approached with a long-term mindset. Don't expect to make huge gains overnight. The market has its ups and downs, it always will. But if you stay calm, follow a clear strategy, and remain patient, the long-term rewards can be extraordinary. For me, real estate and stocks have become the cornerstones of my wealth-building strategy. Each has its own strengths, and both require two non-negotiables: knowledge and patience. If you take the time to study, analyze, and make wise decisions, the results will speak for themselves. Remember, investing is a journey. Success won't come instantly, but if you stay committed, it will come. And when it does, it will be the harvest of every seed of discipline and determination you planted along the way. Step 6. Avoiding debt. Looking back at my wealth-building journey, I realized one incredibly important truth: stay away from debt. Credit card debt and home loans can silently destroy your personal finances, something many don't realize until it's too late. Not everyone understands that having debt not only reduces your ability to accumulate wealth, but also has long-term consequences on your financial freedom. Credit card debt is a problem that most of us can easily fall into. Initially, it seems convenient. Credit cards give us the ability to spend without having to use cash immediately. But the issue doesn't lie in spending itself. It lies in not being able to pay off the balance at the end of the month. Credit card interest rates can be astronomical, and if you don't pay on time, the interest compounds, causing the debt to grow larger and larger. I've seen friends of mine get caught up in this cycle. They'd only charge a small amount each month, but gradually, the accumulated debt became an enormous burden. Credit card debt can destroy personal finances quickly. It was then that I realized that, without financial control and using credit cards intelligently, they can become an invisible trap from which it's hard to escape. Mortgage debt, in my opinion, is even more complicated. Many people believe buying a home is a smart step toward building wealth. This is not wrong, but if you're not careful, a mortgage can be a double-edged sword. Taking out a loan to buy a home can turn into a financial burden if you're not meticulous in planning. Every month, you're paying interest, insurance, taxes, and many other expenses, all of which add up to a much higher amount than you initially anticipated. In some cases, home buyers can face difficulties when the economy falters. If you've borrowed too much, when the value of your property decreases, you could find yourself stuck with a massive debt you can't afford to pay. A prime example of this is the global financial crisis of 2008. Many people suffered enormous losses as property values plummeted, and their mortgage debt became unbearable. During that time, I learned that mortgage debt can be a double-edged sword. Buying a home to build wealth can be a successful strategy, but only when you borrow wisely and only purchase properties that have long-term value appreciation. In some cases, renting instead of buying might be a better choice in the early years. But is there ever a time when debt can be a smart financial strategy? The answer is yes, but only in very specific circumstances. A good example of this is during economic downturns, when interest rates are extremely low. Borrowing can become a way to invest and generate returns. Think about the opportunities that billionaires like Elon Musk and Warren Buffett have seized during tough economic periods. Elon Musk, for example, borrowed money to invest in major projects like SpaceX and Tesla during times when borrowing money at low interest rates made sense. As a result, he was able to use borrowed capital to grow his companies without assuming too much risk. However, the key here is that borrowing is only beneficial when you have a clear strategy and ensure that the cash flow from the debt will generate a higher return than the cost of borrowing. If not, you'll fall into a cycle of debt with no way out. I've learned that If you don't use debt wisely, it will pull you into a financial spiral that's difficult to escape. Credit card debt and mortgage debt can limit your ability to build wealth because they consume so much of your monthly income, preventing you from investing in more profitable opportunities. Living debt-free gives you financial freedom and the ability to control your future. I've seen many people get caught up in debt, unable to invest in new opportunities because they're stuck paying off debts every month. Some have even had to sell off their assets or suffered from negative psychological impacts just because they couldn't control their debt. I realized that one of the most important aspects of building wealth is staying away from debt. Credit card debt and mortgage debt can diminish your ability to build wealth, preventing you from taking advantage of lucrative investment opportunities. If you can live without relying on debt, you'll have more opportunities to invest in areas that generate sustainable profits. Always remember that financial stability isn't built on debt, but on a foundation of financial freedom, where you can control your life and decide your future. Step 7. Mastering financial management skills. We often hear about making money from investments, but perhaps few understand that the key isn't how much money you invest, but rather your ability to manage finances and choose smart investment opportunities. Investing isn't a game of chance. It's an art that requires a deep understanding of the market, a cool head, and a solid strategy. I've learned that investing isn't just about picking the right time. It's about finding opportunities, knowing how to assess them, and recognizing assets with potential value. I can also share a personal experience. One time, while many people around me were pulling out their investments due to concerns over a sharp drop in the stock market, I decided to dive deep and pick up some stocks of companies with strong fundamentals, even though their prices were low. After a short period, the stock value started to rise again, and I made a significant profit, all because I stayed calm and viewed the market from a different perspective. Investment skills cannot be acquired simply by luck. To become a successful investor, you need to understand the fundamental principles of investing, especially the concept of capital turnover. Capital turnover is the process of investing money into assets and using the profits generated from those assets to reinvest in other lucrative opportunities. This principle helps you create a continuous income cycle and grow your assets over time. I've certainly learned a lot from these successful investors. Understanding cash flow, reinvestment, and optimizing returns from your initial capital is one of the key factors that helped me avoid significant financial risks. The next issue I realized is absolutely crucial in investing: the ability to assess and select quality assets. Investing is not about buying something you like. It's about choosing assets with the potential for growth and long-term profitability. Assessing an asset isn't just about its current value. It's about looking at its future development prospects. When you choose to invest in any asset, always make sure that you've thoroughly researched its growth potential. Don't just rely on rumors or short-term trends. Clearly define your goals and see if that asset can help you achieve your long-term financial objectives. I understand that investing is a long journey and it's not always smooth sailing. However, if you know how to find opportunities, understand the basic principles, and choose assets wisely, you'll create sustainable income from your investments. Learn to seize opportunities when the market is on a decline, understand the concept of capital rotation, and always be sharp when selecting assets that fit your financial strategy. Investing is not a short-term race. It's a long-term journey that requires patience, intelligence, and sharp analysis. If you master these principles, I believe you will not only protect your assets, but also build a strong financial empire for yourself. These 7 steps aren't just theory. They're a proven roadmap to building wealth. Each step helps you avoid wasting money, build better money habits, and develop a powerful wealth mindset. When applied consistently, they lead to real, sustainable wealth and long-term financial freedom. Don't chase quick wins. Build a system that keeps you rich for life.